In terms controlling what it can control, I believe Air Transport Services Group's ATSG management team is doing a good job. Even so, there are worries about Amazon's AMZN, future plans for its primary operations, possible competitive losses to Atlas Air, AAWW, higher rates, and access to planes continuing to weigh on the shares, which have underperformed Atlas Air quite significantly since March of this year. I expect Air Transport to expand its business relationship with Amazon over time, but there are no guarantees. Likewise, I believe the company's efforts to expand its ground-based service and conversion businesses will pay off, but not for several years. Although the overall air cargo and leasing environment remains healthy, escalating trade disputes could threaten that, and Air Transport doesn't have a great track record of free cash flow or ROIC generation. That said, there still appears to be worthwhile opportunity here for those investors who can get comfortable with the risks. Air Transport find more planes. Air Transport runs a very focused business built around leasing and operating Boeing BA 767 planes. Management has historically been able to acquire these planes in the secondary market, convert them to freighter use, and then either dry lease them to cargo customers like Deutsche Post's OTCPK, DPSGY, DHL and Amazon, providing just the planes, or provide aircraft, crew, maintenance and insurance, or ACMI, services on a contract basis. Although access to aircraft has historically not been a major issue, the 767 is an aging family of aircraft. The first deliveries were in 1982, and it is getting harder to find aircraft for conversion to freighter service. In fact, of Air Transport's preferred 767-300 model, only a little more than 100 have been built, and Air Transport already owns a quarter of them. I look at this as a risk factor on at least two levels. First, it may limit the company's options for gaining more business with Amazon. If Air Transport can't source the planes it wants, I could easily see Amazon turning to Atlas, which operates a much wider range of aircraft and has more flexibility in meeting Amazon's needs. Second, it may push the company to overpay for aircraft and/or stretch to use aircraft varieties where it doesn't have the same familiarity and experience. No company likes to face a raw materials shortage, and every 767-300 Air Transport can put into the air means roughly $4 million in incremental annual EBITDA. Still, if this prevents management from buying and converting planes on a speculative basis, that is, committing the capital ahead of leasing commitments, I don't necessarily regard that as a completely bad thing. On a more positive note, American Airlines (AAL) announced a few months ago that it would be retiring 25,767-300s over the next couple of years, including 6 in 2019 and 19 in 2020. Air Transport also has a joint venture underway working on converting Airbus A321-200s to freighters, though it won't likely result in flyable planes until 2020. Waiting for other opportunities to scale up. Air Transport's basic operating results from the first quarter showed a continuation of a good trend. Core leasing revenue (CAM-ACMI) was up almost 11% year-over-year, and the company saw 22% growth from external customers in its MRO services business, which includes maintenance for airlines like Delta, DAL, as well as its PEMCO aircraft conversion business. The ACMI business is profitable again now, while the CAM business is generating strong margins, fueling 26% growth in adjusted EBITDA. Air Transport also still has a pipeline of new deployments that it is working on, and management talked of conversations with customers about deploying 767-300s in 2019. Still, there's a hurry up and wait element to this story now. Nobody really knows if or when Amazon will look to expand its commitments to air transport, and it is certainly possible that Amazon could direct more business to Atlas instead of Air Transport, or choose to start acquiring its own planes and running operations independently of these two partners. Air Transport also reported that it wasn't going forward with a JV with OK Airlines in China. This opportunity had been stuck in regulatory hell for some time, and now the company is shifting its focus toward offering conversions through its PEMCO business to existing airlines in that market. While that could be interesting further down the line, it's not going to contribute anything significant in the near term. The opportunity there are plenty of worries in play now. In addition to wondering about the state of the Amazon business relationship, and management's ability to find more planes to convert, investors are likely fretting about the potential risks to air cargo demand from the escalating trade dispute between the U.S. and China, as well as macro factors like rising interest rates. Although many of those worries are valid, there's always something to worry about, and speculating on the near-term health of the air cargo market is pretty much business as usual for air transport investors and analysts. At this point, I don't see a reason to change my modeling assumptions, and between DCF and EV/EBITDA, I still think a price in the mid to high $20s is fair on the basis of long-term revenue growth in the high single digits and meaningful improvements in long-term free cash flow generation, as well as improvements in EBITDA margin to over 30% and a forward multiple of 8x. The bottom line, my fair value range does suggest double-digit undervaluation for air transport, and that keeps it on my watch list. Management has a lot of long-term irons in the fire, perhaps too many, but I don't fault it for thinking beyond its traditional core operations in the pursuit of growth opportunities. Amazon's future plans remain a key risk, but the market seems to be focusing on the threats to the business a little more than seems fair relative to the operational progress. Disclosure: we have no positions in any stocks mentioned, and no plans to initiate any positions within the next 72 hours. I wrote this article myself, and it expresses my own opinions. I am not receiving compensation for it, other than from Seeking Alpha. I have no business relationship with any company whose stock is mentioned in this article.